We're looking at the best companies to buy now that pay dividends every single month. What we're going to do is look at each one's historical performance as usual. We'll look at their dividend safety, run through their financial metrics, and we will get them through our valuation model, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and we'll look towards Wall Street to see what they're forecasting over the next 12 months. So let's start off with the first monthly dividend paying company, which is Realty Income, ticker symbol O. Over the last year, now they have been hammered down 20%. They are trading towards the mid to lower end of the 52-week range. They offer a yield of just under 6% with a P to FFO of just under 13. Now, if you've been holding this over the last 10 years, you would be up 31%. Bear in mind that doesn't include those dividends reinvested. And we see their all-time high before the pandemic, February 2020 at just under $80. Dividend safety score, it is 80, it is safe. Market cap, 38 billion, it is a large cap company. Now, in terms of those who see a recession inbound, last recession, well, they increased the dividend, 07-09. They had above average growth, negative 0.8% versus the S&P's negative 12%. And they also outperformed the S&P negative 43% recession return versus the S&P 500's negative 55%. Dividend growth, well, the last full year, 4%, which is okay. It keeps up in line with inflation, as we always advocate on the channel, a minimum of 4%. Last 5 years, slightly lower. Last 20 years at around 5%. And when we take a look, they have been increasing those dividends for the last 28 years. So they are officially a dividend aristocrat, as they have increased the dividends for 25 years or more. Now, for those that are new to the channel, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. 5.83 versus 4.42, we have our first sign of undervaluation. We have another sign of undervaluation with the forward P to AFFO below the 5-year average of 17.8. So two signs there, but do bear in mind we don't look at any of these models in isolation, and we will conclude towards the end. We also note the real estate P to FFO is slightly higher at 13.6. Now, in each episode, we do tend to focus on the free cash flow payout. However, for REITs, they are a lot more volatile, so we draw your attention to the adjusted FFO, funds from operation. Below 90% is the metric we want to see for REITs. What's nice to note, it is gradually lowering year on year. 2022, 76%, 2023, 76%, and 2024 expected 74%. Very positive, no issues with the payout ratio. Then when we take a look at the adjusted funds from operation per share, very nice to see that consistency, the year-on-year increases. $4 expected in 2023, $4.14 in 2024. So again, continuing those consistent increases. And we can see that here with the adjusted FFO per share growth percentage-wise, looking very nice, around that 5% consistently year-on-year. 2023, 2024 expected 3 to 4%. Sales growth for REITs, we look for moderate growth at 5 to 10%. Very nice to see that the last 3 years have seen some very strong growth from Realty Income, and with their merger of Spirit Realty, this looks to be great going forwards, so we should expect to see continued double-digit growth to the top line. Numerically then, $780 million in sales in 2013, $3.9 billion expected in 2023. One thing to note with REITs, very, very typical for your position to be diluted over the longer term. The reason why they do this is to fund property acquisitions due to the fact that they do retain a little of that internally generated cash flow after paying out as dividends. $192 million in 2013, $670 per the latest annual report. Just bear in mind though, with the different REITs, they do dilute your position at a different rate over time, so just something to be aware of. ROIC for REITs, 3 to 5% for us. It does give us faith that management are able to effectively allocate their capital. It did dip to 2% in 2021, the last 2 years at 3%. Not too bad, it is at the lower end of what we like to see. Just something to keep an eye on moving forwards. Operating margin consistently very strong. Whilst it did dip in 2022, it did pick back up in 2023, and we would like to see continued in the mid to upper end 40s, as we have seen for the majority of the last 10 years for Realty Income. Net debt to earnings before interest, tax, depreciation, amortization shows us the dividend safety as it correlates to the score, as well as the balance sheet strength. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. We want to see below 5.5. 2023 at 5.97 is a little bit high, but it is nice to see in 2023 it is expected to come down to 4.57. So let's jump into the valuation of Realty Income. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, on this channel regularly we do deep dives. We run through every single one of these models. For today's episode, we're going to jump straight into the intrinsic value, which for today's episode of Realty Income is the average of these three models, coming to $65. Now, what we typically do is we use a margin of safety. We start off with 10%, which we use if we believe it meets three criteria: wide moat, strong financial metrics, good forward-looking data. 10% a buy up to $59. 15% we keep going until it comes towards the current price. 20% pretty much a few cents shy. So for Realty Income, we see a 20% margin of safety based on our estimates and judgments. In terms of Wall Street and what they forecast, well, their price target is $63 over the next 12 months. So they see upside of 19%. As always, let us know your thoughts in the comments below as we go along these companies that do pay a dividend every single month. The next company that pays those nice monthly dividends is Stag Realty or Stag Industrial. Over the last year, they are up 7%. Over the last 10 years, up 62%. Although we do note their all-time highs in December 2021 of $48. They're trading towards the mid to upper end of the 52-week range, a yield just under 4%, and a forward P to AFO of 16.5. Dividend safety sits at 60, borderline safe. Market cap $7 billion, a mid-cap company. Now, in terms of recessionary metrics, well, they didn't pay a dividend 0709, and they had average recession sales of negative 12%. Dividend growth, not as nice as we want to see. 0.7% increase last month, 1% over the last 5 years, 3% over the last 10 years. So it is something to be aware of. Their increases aren't in line with inflation, and they have been increasing those dividends for the last 11 years. In terms of dividend yield theory, we do see a slight sign of overvaluation, 3.94 versus 4.43, although we know the forward P to FO is pretty much in line with the 5-year average, 18.4 versus 17.4, and we want to point out here that the real estate sector P to FO is 13.6. In terms of the adjusted FFO payout, well, we do note for industrial REITs, we want to see around 75% as a maximum. And whilst it has been above that over the last 10 years, in 2023 it is expected to be 75% and 2024 at 72%. Adjusted FFO per share, it does increase over the longer term, although we do note some inconsistencies year on year. 2023 and 2024 expected to be higher than the previous year is a positive sign. And when we do look at the percentage-wise of the growth, over the last 3 years, it is looking very nice, and we note 2024 at 4%. Sales growth pretty much double-digit every single year, very strong to see. 2023, a subpar year in comparison to the previous years at 9%. Still, it is within that 5 to 10% that we do target for REITs. Sales then, it has been increasing very strongly over the last 10 years, 134 million in 2013, 695 in 2023. And remember, as I said with Realty Income, they do dilute your position over the longer term. Stag as well as O, in my opinion, comparing to other REITs, are ones that do dilute your position at a much faster rate than other REITs that we have reviewed on the channel. ROIC, it was pretty low from 2013 to 2017. Nice to note it has been increasing, and it is positive to see that 4% in 2023. Operating margin as well, nice to note it has been increasing year on year. 33% in 2023 for this industrial company is a positive sign. Net debt to EBITDA, we can understand why we see that borderline safe score above. It is sitting at around 5.04 in 2022, with the annual report waiting to be released, 4.92 expected and 4.6 in 2024. Does give us a lot of faith in not just their balance sheet, but as well as that dividend safety. So Stag Industrial, let's take a look at the analysis. And don't forget, if you do want to grab a copy of this model, you can click on the pinned comment below to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list as well. Margin of safety at 10%, we can see it is around 6 cents shy or 5 cents shy from the current price. So we see a 10% margin of safety for Stag. And when we look to Wall Street to see their forecast, they see around $41 over the next 12 months with upside of 9%. Moving on to company number 3 for those monthly dividends that we love, it is Main Street Capital. Now, over the last year, a very strong performance, up 15%. Over the last 10 years, up 46%. And we can see they are trading towards the 52-week high. A yield of 6.5% and a forward PE of 10.75. Dividend safety, it is safe, 62 score. Market cap just under 4 billion. It is a mid-cap company. In terms of those recessionary metrics, while they maintained the dividend, they didn't increase it, but they also didn't cut it. They had above average growth and they significantly outperformed the S&P with a negative 25% recession return. Dividend growth, 2.1% in November 23, below the 4% we do advocate on the channel to keep up in line with inflation. 3% over the last 5 years and 4% over the last 10 years, although we do note they do from time to time pay special dividends, and we can see the dividend growth over the last 12 years of consecutive increases. Dividend yield theory, then we can see reasonable valuation, 6.47 versus 6.53, although we do note the forward P of 11.1 is significantly below the 5-year average of 15. And in terms of the sector P, it is pretty much in line with the financials of 11.2. So let's take a look at the earnings payout, given, again, it is very volatile for BDCs to focus on the free cash flow. Below 95% is our target for BDCs. Now, we do see a quite high over the last few years. It is positive to note, though, in 2022, 79%, 2023, 67%, and 2024, 72%. But it is something just to keep an eye on. In terms of earnings per share, it does grow nearly double over the last 10 years. $4.05 expected in 2023, $4 a little bit of a drop in 2024 anticipated. And again, do note the inconsistencies, although in the longer term horizon, it does move forwards, it does increase. So when we take a look at the sales, for those that want to see the numbers, over the longer term, it has gone from 116 million to 485. They also do essentially do share buybacks, very similar to REITs. We can see they do have high payout ratios, and they have to borrow money and issue shares to grow their business. So this isn't a surprise when analysing their shares outstanding. ROIC then above 8% for BDCs. Pretty much straddles around 7 to 8% continuously. Nice to note, double-digit 10% in 2023. Now, when we do focus, one thing just to note, whilst we typically do look at the operating margin, it isn't meaningful for BDCs due to the fact that interest is a core component of both their revenue and expenses. And again, very similar, therefore, for full transparency, they don't have it relevant for this metric that we do tend to use for each company we do analyse. So let's jump into the valuation of Main Street Capital, and what we can see in today's episode in terms of that intrinsic value, it does arrive at $54. Now, in terms of the current price, we do start off with that 10% margin of safety. It is a buy up to $48 if you believe that it suits those criteria. 15% a buy up to $46, and at 20% it isn't quite there yet. So we see a 15% margin of safety for Main. In terms of Wall Street and what they forecast over the next 12 months, well, they have a price target of $47.50, so they see upside of only 5%. As always, let me know your thoughts. I do know that Main is a very, very great company in the dividend community. A lot of people have a significant amount of shares in this BDC. We then move on to another REIT, which is Agree Realty Corporation. Down 20% over the last year. Over the last 10 years, however, it is up around 94%. And we can see it has hit its all-time highs a few times at $80 over the last few years. It's trading in the mid to lower end of the 52-week range with a yield over 5% and a P to FFO under 15. Dividend safety score, it is 70. It is safe. Market cap just under 6 billion. It is a mid-cap company. In terms of those key recessionary metrics, well, they cut the dividend, unfortunately, in the last recession. They had average growth, but they did also trail the S&P with a negative 67% return. Dividend growth, 1.6% in October 23, again below that 4% inflation rate we tend to target. 7% over the last 5 years, a little better. Over the last 20 years, however, year on year, it has been below inflation. And we do know they only have 10 years of consecutive increases due to that dividend cut we saw in 2010. So let's take a look at dividend yield theory. So we see that sign of severe undervaluation, 5.15 versus the 5-year average of 3.82. Forward P to FFO, 14.2. It is below the 5-year average, so another signal of undervaluation. And we note it is higher, however, than the real estate sector P to FFO of 13.6. So Adjusted funds from operation pretty consistently around the mid-70s. Always good to see when the metric is very strong and it is very consistent. It is something that I do quite like to see. Adjusted funds from operation pretty continuous in their increases year on year. 2023 and 2024 expected to be more of the same. In terms of sales growth, double digit, very strong year on year, very positive, and the adjusted funds from operation per share growth as well, looking very strong, although we do see it simmer down a little bit in 23 and 2024 expected. Total sales then, if you want to see the numbers, pretty much more than 10 times growth over the last 10 to 11 years. And again, unfortunately, they do dilute your position at a very quick rate. Always important to factor this into your information and your investment thesis. ROIC, unfortunately, has been decreasing, now sitting around 3%. This is personally, for me, the lowest I would like to see. So if this was a company you're looking to invest in, this would be something I would say just to keep an eye on. Margins, whilst it has decreased over the last 10 years, it's still looking very solid at 49%. But again, if we are seeing trends continue over long periods of time, it is definitely something I would say to keep your eye on. Net debt to EBITDA, pretty high consistently, although it's nice to note 5.49 in 2023, and it is expected to be lower in 2024. Again, there are a few metrics that I would say just to keep a close eye on. Let's jump into the valuation then, and as always, if you do enjoy the content, do smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. 10% margin of safety, a buy up to $59. 15% not quite there yet. So for Agree Realty Corp, we do see between 10 to 15% as a margin of safety. In terms of Wall Street, well, their price forecast is $67. They do see this as a strong buy with upside of around 17%. We then move on to another strong monthly dividend payer, which is Gladstone Investment, up 11% over the last year. Over the last 10 years, up a strong 116%. Again, keep in mind it doesn't include dividends reinvested. And they're trading at the mid to upper end of the 52-week range, with a yield now touching nearly 7% and a forward P of 16.2. Dividend safety 41, it is borderline safe. Market cap 500 million, it is a small cap company. In terms of recessionary metrics, well, they cut the dividend during the last recession, below average growth, and also trailed the S&P with that negative 76% return. Now, they haven't increased that dividend just yet. Over the last 5 years, however, at 4%, and over the last 10 years at 4%, at least in line with inflation at the bare minimum, whilst getting a fairly strong dividend increase. In terms then, as we can see here as well, they do special dividends similar to Main Street Capital, and we can see, looking at dividend yield theory, 6.92 versus 6.87, a sign here of reasonable valuation. Forward PE 13.3, below the 5-year average of 15.1, so that is a sign there of essentially undervaluation, and we note the financials is slightly lower at 11.2. So in terms of the essential payout ratio, again, as a BDC similar to Main, we do focus on the earnings. It is very, very inconsistent, and there are quite a number of years over 100%. Something just to bear in mind, 2023 at 84%, 2024 expected 92%. This is one that I would keep a very close eye on, especially given how high that yield is, and we do see that borderline safe dividend score. Earnings per share, very, very volatile, very inconsistent, 0.73 in 2014, whilst it's 1.11 in 2023, 2024 is expected to drop, so it isn't that consistent. Sales growth, though, we do note double-digit growth every single year, or in fact, for the majority of the last 10 years, although we can see here negative 9% in 2021. Numerically, then, what we can see, they've more than doubled their top line, 36 million in 2014, 82 million in 2023. And again, similar to Main Street, it is a BDC. As we mentioned, they have to borrow money, issue shares to grow. So we can see it has increased from 26.5 million to 34 million in 2023. ROIC, it doesn't quite meet that minimum 8% that we want to see. 7% in 2023 is still okay nonetheless, but again, just something to keep in mind moving forwards. Again, operating margin as well as the net debt to EBITDA not relevant for BDCs, again, as interest is a core component of their revenue and expenses. Nonetheless, we are just making it transparent by showing that here. So let's get into the valuation. Don't forget, you can grab a copy of this model if you want to be able to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list by clicking on the pinned comment below. Now, Margin of safety at 10% is a buy up to $15 in our opinion, based on the estimates and judgments. 15% still a buy, at 20% not quite there yet, so for gain we see around a 15% margin of safety. In terms of Wall Street and what they forecast, well, they see upside of around 6% with a price target of $14.75. Also, just to let you know, we have released our latest free weekly newsletter discussing insider buys and sells that we have seen in the market over the last few weeks. We have other articles discussing undervalued companies with strong upside, as well as our 7 golden dividend metrics to screen undervalued stocks. If you want to sign up completely free, click on that pinned comment below, and we'd love to have you join us in our community. As always, if you have enjoyed today's episode, smash that like button, hit that subscribe and bell button. We'll see you on the next one, and for now, take care.